All right. Good morning. Indeed, fall is here. All the leaves are brown, and the sky is definitely gray. Although there's a little bit of sunshine behind me today. If your yard was anything like mine, man, what a bomb went off in it, and I'm not looking forward to the job that awaits there. Okay, let's dive into it and see what's what for this week, shall we? Day 27 of the federal government shutdown. Not a whole lot at all has happened or changed since this thing began 27 days ago. Most of the predictions are now saying it's going to go to 41 days. That's pretty scary. As of right now, 900,000 folks are furloughed, sitting at home and not being paid. Another 700,000 are working for free. And that includes about 11,000 air traffic controllers. Hat is off to them. Thank you for all your hard work. Unfortunately, all of this is forcing, especially government employees and military families, that they are heading to the food banks a lot more. And so we're seeing the food banks are overwhelmed and almost starting to turn away people because they're running out of food. With regards to what's happening on housing, if you have an FHA loan, it's going to be slower than before. The IRS itself has furloughed about 50% of their employees. So if back end verification of income is required, especially if you're self employed, that'll be a little bit slower than what it is that we're used to. Federal workers themselves, if they're furloughed, uh, there's nothing that anybody can do for them as far as giving them financing. So we're seeing some transactions sit on the sidelines and or get canceled as a result of it. And unfortunately, all the meanwhile, the stock market's like, come at me, bro. And I'll explain that in a second about why that is. We'll come back to that in 2 seconds. So listen, the Federal Reserve has two mandates. Remember that, right? One is to control inflation. The other one is to maximize employment. And right now, based on the last CPI report that was released in order to get Social Security recipients tidied up, it came back on Friday. Even though the departments are furloughed, they brought back a skeleton crew and they produced a CPI report that showed that inflation was at 3%. Now they expected to be at 3.1, so they were cheering. But to me, that's like your kid comes home, you were expecting an F and he came home with a D. Things are not okay. You still got a D. You still have inflation at 3%, which is too high and above the 2% mandate that they are trying to run off of. Now, the reason why the stock market's saying, come at me, bro, is this. Over the last 6 months, it's gone up 17%. This is the Dow Jones, okay? And so what we're seeing at this point is the stock market's rallying and being very optimistic because of the fact that they know that a Federal Reserve quarter point rate reduction is around the corner. As a matter of fact, it's going to be announced on Wednesday. Now, when the Federal Reserve lowers the Fed funds rate, that has nothing to do in a direct correlation with mortgages. I'll explain in a second. So when they reduce the Fed funds rate, they are reducing the rate that banks use to borrow monies from one another on an overnight basis to maintain their reserve requirements. When that rate is cheaper, banks are more freely lending money out to one another, therefore lending it out to the public and companies, et cetera, right? So that is a stimulant in the economy. Now, the last thing that the economy needs is a stimulus when it's already running too hot, yeah? You're already wigging out in your morning coffee and you have two more cups. So let's look at what's happened in 2024 when the Federal Reserve reduced the Fed funds rate a half a point, reduced a quarter point, reduced a quarter point. And what happened? Mortgage rates shot from 6.1 to 6.9. Why is that? Well, because all these reductions in and of themselves are inflationary. But the reason why the stock market is saying, come at me, bro, is because of the fact that all the corporate debt that they owe is going to go down in interest rates, right? Because when the Federal Reserve reduces the Fed funds rate, they also reduce rates like your credit card rates, your home equity line of credit rates, not your mortgage rate, but a lot of the corporate debt that is tied into corporate bonds, that rate ends up coming down some. That's why you're seeing what you're seeing. So hopefully now you're that much smarter than the next guy. You understand why some things are going up and some things are coming down, okay? Mortgage rates. A lot of the anticipation of the Federal Reserve lowering the Fed funds rate has already been baked in. Look at here. Last year it was last week it was 6.2. Today is 6.19. Just a few basis points, but hey, it's lower and we'll take it. The biggest culprit about this is the bond market understands that labor is slowing. and they're predicting that we're going to have unemployment around 4.3 to 4.4%. So if that's the case, the Federal Reserve will be forced to lower the Fed funds rate to try to stimulate the labor markets. Okay. Quick note, just to remember, these rates are national averages. They're on purchase loans, not refinances. 25% down and 780 credit score. So if you want to know your actual factual rate, reach out to us. We're happy to supply that with you and supply that for you and go from there. Okay. What to watch for this week? Really, nothing is more important than this guy right here on Wednesday. Right now, the bonds are trading very, very tightly over here. We had a negative stochastic crossover over here, but still in an overbought territory. So, again, all of this is anticipation of what's going to happen on Wednesday. So buckle your seatbelts. I wouldn't be surprised if we see a rate bump when Wednesday comes. But again, follow me on Instagram. We're going to post daily rates there, and we're going to give you commentary every day so you will be smarter than all the other folks out there. Hit all my buttons, please. Subscribe, like, comment, share, do all that so everybody can be as smart and in the know as you are. And as always, we're just a phone call away. If you're stuck on something, give me a call. Happy to help you. Okay?